Video number 3, Camarilla Pivots. Last video we covered the basic rules, the general ebbs and flows of how they're traded. This video I want to share some tips and hints and things that have come to my realization through experience, and hopefully they'll help other traders who are just learning, and they'll be able to avoid either these mistakes and be aware of these behaviors to trade Camarilla more advanced. And the most advanced part will become to the later videos with the CPR, Central Pivot Range, and Camarilla together. But for now, we're just focusing on Camarilla. One tip I previously mentioned in the last video, you often see the first move to L3 is a false move. This alone is a powerful thing to be aware of, because right off the bat, when UTC, the daily closes, you're going to have a lot of people rushing to for that breakout, or they think this is it, this is it. This is a time when reversion algorithms start operating. This is a time when traders are closing out their trades. Together, these things generally bring trades the other direction when coupled with the traders from the other side of the world, the other time zones that are coming into the market and seeing the opportunity of an oversold or overbought price. They will even add more to this as they jump in to trade it the other way. In this moment, you will find that reversion algorithms, you will find that profit takers, people closing out their trades, and you will find that opportunity seekers from new participants all come together in confluence to send the price the other way. This is often why you see the first L3 or H3 as a reversal. Market here example. Market closes. Price is going down. You have some eager traders that are want the breakout, right? A breakdown. But this is the time when many traders are going to be closing their trades, taking profits. New traders from the other side of the world are going to be seeing the low price. They're going to buy, and you're going to have a lot of bots and algos that are just naturally set to revert price to the mean. And that is why you generally don't want to jump on a breakout move for the first range visit. I'm going to share some other tips. You usually never want to trade the pivot setups until after close, after price has visited one of the levels. Those are your entry levels. Be patient for them. Don't join with the group that's rushing into a last-minute trade right before the market closes, especially if the market closes and it's going strong in one direction. More often than not, you're going to find the price open and not too long after go the opposite direction. And this, for many people, is how they get chopped up. For Camarilla Pivot traders and people who are aware of these levels will be able to jump in the market, like here, jump in the market and get a foothold on their day. They'll be able to go up to the H3, maybe take another trade. They'll be able to be ready to get the flow, because I noticed when trading Camarilla Pivots, just starting the day with a good trade, it leads you on the right track, and you're on the right track as far as the market's flowing. You bought at the support, now you're taking profit at the resistance. You're assessing when the US market opens, is we going to break this resistance, or are we range trading again? Another thing to be aware of, just as you don't want to jump in the opening before our levels have been met, you don't want to go heavy on reliance with these levels in the last, let's say, 25% or 1/3 of the day. The longer these levels go without being broken or reacted upon, the less meaning they have, and the more the algos and the bots of the market are shifting to the developing levels. Some indicators, including ours, which is in the post, have the ability to show the future pivot H3, L3. Now, these can change regarding new price discovery prior to the market's close, but these can tell you where the next H3, next L3, and central pivot is coming in at. And if you turn these on prior to the market closing, you can even get an idea of what you're going to do when the next day happens and get an idea of generally how the market's moving, what's going to be the likely scenario. Like if the day closes and we're near the L3, well, chances are you're probably going to be looking for a reversal trade upwards or vice versa. You can get a plan ahead of time. And you can ladder yourself in. Be ready, because remember, these levels can change if the price moves drastically before the daily closes. Now, aside from that, how you want to take profits. There are some tricky methods that are also very helpful for taking profits. I'm going to use this one as an example. Let's say you took a long here on this L3 and you got to H3. The price is straight up just rocking, right? Maybe not this much, but oftentimes it will, like over here. Here's a good example. Okay, and then it goes into a breakout, but it ranges for a while on that 3. So you don't know if you want to trade it down, reversal, H3 to L3, or if you want to wait to see if it breaks out. This is when 2 accounts can be quite helpful. You can take your L3, H3, close half of that trade, keep half of that trade in case it does break out upwards, and use another trading account. Take that L3 or that H3, set your stop loss at H4. And then if you're wrong, you get stopped out at H4, you still have the first position, half of it left over for the breakout play. It's like insurance. You're covered both ways. You're trading both situations. And I realize that can get a little complicated for new traders, but it's something you can get used to. You can manage your trades and be aware of both possibilities, and you can proportionally manage your risk by how much damage that H4, L4 stop loss is going to take in comparison to the reward for how much. So if you if you shorted H3 here, but a stop loss at H4, you got stopped out, but you hit the breakout targets, that's a lot more. There's a lot more meat on that than the damage of that stop loss you took. So it was worth it to have your both directions and possibilities hedged with one position while trading the other position. And this is a more advanced methods for the Camarilla. And I think it's not really necessary. Also, when you see a trending market, how you know it's trending, it keeps on going to the down levels. It keeps on hitting the breakdown targets like here. You can trade an L3 to H3. You can trade L3 and take some profits off these. But when you are reversal trading against the general trend, it's more wise to take profit on the other range side and to hold out for some position for the breakout targets with the macro trend. So if I were shorting H3, I would be more inclined to hold for L5 than I would this long. I longed for, let's say I longed here to see if it goes to H3, but I'd be quick to take profit on this because I know it's not in the general trend's favor.